In late 2008 to early 2009, the world almost lost its entire financial system, which could have taken with it the world economy. How could something like this happen? Could it happen again? Is it happening again? In this video, I will show you exactly what took the US economy and the global world financial system down to its knees back in 2008 and 2009. I'll show you how to recognize the signs of it happening again and how to avoid having it impact you and your entire family. Now, I want to preface this with the fact that I will not be giving you specific investment recommendations. Rather, I will be giving you the tools to recognize both good and bad investment characteristics. Now, first and foremost, it's important to understand what caused the economic collapse of 2008. Now, I want to play a quick clip for you from the movie Too Big to Fail, which aired on HBO back in 2009 or 2010 or something like that. But the reason why I want to play this is because it does a really good job of explaining in layman's terms exactly what happened and what took the financial system down to its knees. So check this out.
I hate to do this right now, but I'm gonna have to have a press call first thing, and I really don't know what I'm gonna tell them.
Tell them Lehman exacerbated AIG. The simultaneous payouts of CDOs and credit default swaps put catastrophic pressure.
Go back further.
The global pool of investment capital.
She has to do this in English. Start with the homeowners.
Okay, here's how you explain it. Wall Street started bundling home loans together, mortgage-backed securities, and selling slices of those bundles to investors. And they were making big money. So they started pushing the lenders, saying, come on, we need more loans.
The lenders had already given loans to borrowers with good credit, so they go bottom feeding. They lower their criteria.
Before, you needed a credit score of 620 and a down payment of 20%. Now they'll settle for 500, no money down.
And the buyer, the regular guy on the street, assumes that the experts know what they're doing. He's saying to himself, if the bank's willing to loan me money, I must be able to afford it. So he reaches for the American dream. He buys that house.
The banks knew securities based on bag mortgages were risky.
You'll work on bag.
So to control their downside, the banks started buying a kind of insurance. If mortgages default, insurance company pays. Default swap. The banks insure their potential losses to move the risk off their books so they can invest more, make more money.
Well, a lot of companies insured this stuff. One was dumb enough to take on an almost unbelievable amount of risk.
AIG.
And you'll work on dumb.
And when they ask me why they did that?
Fees.
Hundreds of millions in fees.
AIG figured the housing market would just keep going up, but then the unexpected happens.
Housing prices go down.
Poor who bought his dream house, the teaser rate on his mortgage runs out, his payments go up, he defaults.
Mortgage-backed securities tank. AIG has to pay off the swaps. All of them, all over the world, at the same time.
AIG can't pay. AIG goes under. Every bank they insure books massive losses on the same day. And then they all go under. It all comes down.
The whole financial system? And what do I say when they ask me why it wasn't regulated?
No one wanted to. We were making too much money.
Now, although this video does do a pretty good job of explaining what happened when it comes to mortgages and how investment banks were packaging these mortgages and selling them off to investors, what they don't talk about in this video, there's two main things. Number one, the people who were taking out loans to buy houses were doing so when home prices were at all-time highs, or at least reaching all-time highs. And let me remind you, the only time you make money investing in something is to buy when the price is low and sell when the price is high. You should look at what it's going to cost you to buy the proposed investment. Whether it's a stock, a bond, a home, cryptocurrency, gold, silver, anything else. You should understand what influences the performance of this investment, whether it be supply and demand, interest rates, competition, and ultimately your likelihood of selling this investment for a profit at some point in the future. In addition to evaluating the price of the investment, it's important to understand the other benefits you may gain or what it may cost you to own the investment. Does it pay you interest? Does it pay dividends? Will you have to pay taxes as it grows? Will there be any tax benefits? Will you have to borrow money to buy the investment? And if so, how much will you have to pay in interest? These are all very important and critical factors. And never determine whether or not an investment is a good deal by looking at the past performance as your primary reasoning. Determining whether or not an investment is good or bad is quite simple, actually. But by looking at the investment's past performance, you can make an investment or an informed decision as to how expensive or inexpensive this investment may be. Okay, so I said there were two things that this video didn't really talk about. The fact that people were buying things at all-time record high prices is one of them. Number two, the other thing that isn't much discussed regarding the 2008 economic crisis is how it impacted the everyday investor or the everyday person. People who weren't buying homes during this time and who didn't have anything to do with the investment banks who eventually had to be bailed out by us, the American taxpayers. Banks were buying mortgage loans from mortgage lenders, bundling thousands of them together and selling them as one large bond investment. Pays interest to the investor. Now, since the basic law of risk and reward still applies, the rate of interest paid to investors was higher when there were more risky loans bundled together. And because there was a high amount of interest that was being paid to the investors, these mortgages-backed bonds would be worth a lot of money. But this also meant that there was an increased amount of risk, that the borrower of the mortgage loan could stop paying their mortgage payment and default on the loan obligations, and reduce or even eliminate the amount of money that the investor would receive back in the future. And when this happened on a large scale, many people lost a lot of money. But get this, these investments were not only created by the investment banks, but they sold these packaged, mortgage-backed investments to pensions, mutual fund companies, and 401k plans, and other private investors like you and me for a huge profit. And when the bubble burst in 2008 to 2009, the everyday investor who had them in their pensions, their 401ks, and any other savings invested in these mortgage-backed investments took huge losses. Not only that, but it became a domino effect. First, it was the investment banks, the retail banks, insurance companies, and any other huge institution that had exposure to these investments, who lost billions of dollars. And this caused people to lose confidence in the financial services industry as a whole. They started making a run on the banks. They started withdrawing all their money from places like Charles Schwab, Goldman Sachs, JP Morgan. And this ultimately led to a damaged banking system, causing enormous businesses like GE to not have the money needed to finance their day-to-day operations. And then those businesses suffered. So it's critical to look at the big picture when trying to figure out where to invest your money. Unfortunately, media hype, corporations with a vested interest, and a desire to get rich quick can prevent us from doing some critical thinking. Let's just look at a couple examples in today's environment. Let's take the three major stock indexes, and I've put these graphs right here. One of them is a major bond index, and then you have the S&P 500, the Dow Jones Industrial Average, and the NASDAQ. And look at a 20-year history that's illustrated right here. It doesn't take very long to realize that we're all sitting at record highs in these investments. And it's no different for the housing market as well. These charts alone cannot determine whether or not they're good investments. We would need to look at how interest rates, tensions in the Middle East and with North Korea, the value of the dollar, and other big picture economic factors will impact stocks, bonds, and real estate. After we've taken a look at these big picture items and determine whether or not something could be a good investment, it's critical to evaluate the possible alternatives that may also be a good investment. You may find that things like precious metals, commodities, or other hard assets might be a better choice to put your money in. It is here that we must begin when evaluating whether or not to invest in something. If we get this wrong, fees, taxes, and any other small details are meaningless. The people who lost half of their investment portfolio during the '08 crisis could care less whether or not they were being charged 1.5% or 0.5%, or if they had to pay capital gains taxes. They lost a lot. And let me finish by saying this. Do not trust anybody to give you the perfect investment advice without doing some of your own homework. It doesn't matter if they're a coworker, somebody who writes articles for financial newsletters, someone you see on TV, or financial advisors in the industry. Most of the people who lost significant amounts of money in the last crisis, they lost everything at the expense of the advice of somebody calling themselves a professional. We're all responsible at the end of the day for our decisions, and it is my goal to give you the tools and the resources necessary to help you make the best and the most informed choices. I want to thank all of our loyal subscribers for all of your support. It's because of you that we're able to create this content and help people in defending their finances. If you're new to the channel, I want to thank you for taking the time to watch this video. This channel is all about providing you with the information you need to make great financial decisions and to try to help you to identify scams and frauds in the financial services industry. Now, we're here to help you. So click on the icon right here to subscribe and to be notified of future episodes. Also, don't forget to give this video a thumbs up and leave a comment in the comment section below, letting me know what you would like to see in future videos. Click here to see other videos and share them with friends and family that you think would benefit from knowing the behind-the-scenes truth about the financial services industry. For now, this is Dean with Defending Your Finances. Stick with me, and I'll reveal to you the truth that few people know and almost nobody in the industry talks about. Thank you for watching, and God bless you and your families.